All right, so let's begin the show. And on the Money Show, we make sure that we just don't talk about investing in mutual funds, but also help you meet the brains behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Roshan Chutkey, Senior Fund Manager, ICICI Pru India Opportunity Fund, ICICI Prudential Mutual Fund. And let's take the discussion forward and understand about this fund and its investing mantras and top themes for this particular sector. Thank you so much, Roshan, and good evening. Welcome to the show. Today we're going to talk about India Opportunities Fund that you handle. And before I get into the details of the fund performance and the kind of structure it has, let's just talk about thematic fund because it belongs to that category. Broadly speaking, what kind of thematic funds are available and how different is your fund?
Thanks for having me on the show, firstly. If you look at the India Opportunities Fund as such, this is a special situation style of investing that we adopt in India Opportunities Fund. Essentially, to give you some bit of a background here, there's this famous fund manager, famous investor known as Anthony Bolton, who ran Fidelity Special Situations Fund in UK for about 28 years, from 1979 to 2008. And very successful at that, about generating about 19% CAGR returns. Right? At some point in time, it was the UK's largest fund, open-ended fund. And we don't have this style of investing in India. And this product gap is precisely what we are filling in through this India Opportunities Fund. It's a special situations investing that we follow, like I said. Now, what is special situations investing? Essentially, special situation is any situation which is causing the company some sort of a problem, right? But the problem is very unique. It's a unique situation that the company is going through. And we broadly, from our experience of managing this fund for about 4 years now, we gathered that each of the special situations that a company faces can be categorized into one of the four following buckets that I'm going to elucidate about. Right? The first bucket can be something like company-specific special situations. What I mean by that is, say, a company like a large IT services company which went through this whistleblower problem back in the day. Or it could be a small cap pharma company which went through this IT rates problem. Right? That is a very company-specific special situation. Moving on, the second category is what we call as the sector-specific special situations. Now, these could be of the nature of, auto sector facing semiconductor supply issues, or it could be, telecom sector facing consolidation issues. One large player emerges and it leads to the death of many telecom players, right? So that is a sector-specific problem, right? The third category is what we call as the regulator or government-led special situations. Now, what are these? These could be of the nature of, OMCs absorbing the increase in international oil prices and seeing a sudden dip in their marketing margins. Or it could be telecom sector facing AGR related issues. Or it could be IMO mandating that ships cannot use high sulfur furnace oils. Right? So these are all sector or rather regulator driven special situations. And the fourth category is what we call as the macro-driven special situations. These could be of the nature of, US-China enter into this trade war, because of which you see metal prices crashing big time, right? Or it could be Brexit leading to a large auto major facing problems in UK market, their investment plans getting derailed, right? So these are macro-driven special situations. Right? Broadly, in our experience, like I said, any special situation can be broadly categorized into one of these four buckets. Right? These are not run-of-the-mill problems. It's not an earnings miss problems you're talking about. We're talking about a very unique problem which is not recurring often. Right? And whenever such a problem happens, what tends to happen is the stock invariably corrects. Right? And your price point becomes very attractive if you want to invest into that particular stock.
Right. So based on these factors, you're trying to tell me, based on these factors and the valuations which might have gone cheaper at that time, you pick up companies which have a better and brighter future?
Absolutely. So the upside is fairly limited, and in our assessment, if we believe at that point in time the downside risk is fairly limited based on a special situation, the risk that a special situation throws up, we go ahead and invest in those companies. Right? It's a high return, high risk scheme, right, from our stable, uh, and the weight of the particular stock in the portfolio is decided based on the number of risks that a particular that a special situation throws up. For example,
Roshan, talking about the current scenario and the four situations that you just laid out, that you just explained, what exactly are the current situations or triggers that might just classify into these three, four types of scenarios?
yeah, for example, let's say you have these the recent budget announcement where life insurance companies were not allowed, not were asked for the policies with greater than 5 lakh ticket sizes were asked to for the investors had to face marginal taxation rates, right? That's a special situation which is in the third category, right? If you look at the injectables business, the pharma companies which do injectables business, they're seeing significant competition, right? That's again a sector specific problem, right? If you look at a biosimilars company which is facing a very company specific problem wherein it has to reduce its debt, bring down its leverage, so as and in the process it is selling a significant stake in one of its subsidiaries, right? So that's a company specific problem, right? So these are some of the special situations, the current special situations at this juncture.
All right. Let's talk about the current scenario also before I go deep into the fund performance and the kind of risk and reward ratio investor needs to understand before investing in a theme like this. How is the market looking to you? How are you reading it?
See, from a market standpoint, market view perspective, while while there has been significant correction, the correction has been for a reason, and that is largely to do with the global slowdown. Right? When you have global slowdown happening at a time when the interest rates are fairly high, right? They're not still yielding. We still don't have a situation where we can see them coming off uh, from these levels, where we can say that the peak interest rates have been achieved at. It is better to be a bit cautious uh, while we understand the long term opportunity that the Indian market has for its investors. We got to be a bit more cautious at this point in time and own something like sectors like utilities, telecom utilities, power utilities, pharma sector, which has been a rank underperformer and is fairly resilient in terms of its business conditions, right? Large liability franchises which can withstand the challenges that these cautious global slowdown brings about, wherein large liability franchises can withstand the liquidity problem, liquidity decline that we have seen in the at the last window, right? So these are some of the sectors that we are very positive about. Uh, we are negative about sectors which are more consumer oriented, consumer focused, because as we believe the big demand conditions will continue to remain weak for some more time to come, uh, right? So from that perspective, we are still negative on or cautious at least on the consumer names.
Okay, Roshan, I really want to understand that how in this fund you actually control the losses in a falling market. The kind of triggers you've mentioned, these are very short to near term triggers, and after that, the market will obviously change the kind of breadth they are into. So, how do you control the losses in this particular fund? Because it's a high risk fund as well, and the triggers keep changing. So does your selection of
Right.
companies and stocks. How do you manage that?
So, like I was talking about it, there are two aspects to controlling losses, right? One, whenever a special situation happens, invariably the stock becomes attractive. Now, our research focus at that point in time is ensuring what is the stock price baking in. Are all the risks that the special situation throws up, are they all priced in, well and truly priced in or not, right? And if not, what is the kind of downside you're talking about, right? only when we are convinced that the downside is fairly limited, and if there is any downside, it has to be because of purely irrational market reasons, uh, we go ahead and buy into that particular stock name, right? Now that is one. The other part is, say, like I was talking about earlier, the number of risks that a particular stock presents, right? Let me elucidate this with a point with two stocks. One stock which is a large auto major which operates in multiple countries. Back when we invested into that name, uh, there were multiple special situations. There was Brexit issue. There was a large leverage problem. There was a luxury car market problem that the company was going through, market share problem that the company was going through, right? And then you had capital allocation problems as well. Now, given the number of risks that this large auto major was facing, we said we should contain our weight in this particular stock. Whereas there was this other company from a large corporate house. Again, it's an aluminum manufacturer. This company was being treated. A significant portion of its company's revenue comes from the converter business, whereas it was being treated as a beta play on the commodity, right? The risks we felt were very trivial in the second case, and therefore we went ahead and built a large position. But mind you, in both the cases, the risks that the special situation threw up were fairly contained, right? So the downside risk was fairly protected. We were playing for a large upside, but because the number of risks in the former case were just too many, we said the weight of the position has to be fairly capped. Whereas in the other case, we built a fairly large position, right? So one, because our research says that the downside risk is fairly limited, we control the risk as such, right? The downside risk. And two, by virtue of weight as a weighing mechanism, we again contain the risks that a particular stock can throw up based on the special situation.
Uh, Roshan, in the current scenario, what is the market cap exposure like in the fund?
As in, you mean
The large cap, mid cap, small cap, yeah.
Large cap. So we are. It's a flexi cap fund, right? I wouldn't know the exact composition of the large, mid, and small cap, but it's a flexi cap fund. We are. As things stand, it's a fairly large cap biased portfolio. I can say that for sure, right? We have a significant tilt towards the large cap. Uh, but then it's a flexi cap fund. It's a sector agnostic fund. We the active risk that we seek in this fund is fairly high, right? And therefore, it becomes a high risk, high return fund.
Your top 5 sectors would be where you're heavily invested right now?
Right now would be telecom and power utilities,
Okay.
right?
Okay.
Then we have exposure to pharma companies, and we have exposure to large liability franchises.
Trajectory for these sectors in near term or maybe 2 to 3 quarters is how, according to you?
The prospects still look great for these names, right? The names that we own, right? We believe this should also provide downside protection at this point in time. Not only is there upside that these stocks present, but they should be less volatile compared to the rest of the market, right? So though it's a high risk, high return fund, given the market conditions, these stocks should, because they are resilient businesses to the market conditions, these stocks should do quite well, is in our opinion.
Numbers, the earning numbers are of not much concern for you?
Sorry, just repeat that question, please.
The corporate earnings or the earning numbers, which will be released now in a few days, we'll start seeing almost all of them coming up with their numbers. So that's not of concern for you?
Yes, I mean, there could be volatility in some of the corporates, particularly for the ones which are linked to the consumer, right? Consumer-facing sectors could see a reasonable volatility in their performance. But the ones which we have in our portfolio, like the utilities businesses, should have fairly defensive earnings profile, and which have defensive earnings profile should be okay in terms of their earnings performance in our opinion.
What should be the return expectation from an investor's standpoint?
I can't talk about return expectations, right? I mean, but the way I can talk about the investment philosophy. See, we have a very well laid out process, I believe, in this fund, right? We are investing into names when they have crashed, when they have not done well, right? Therefore, the downside risk, if our research says the downside risk is fairly limited, we are playing for a large upside, significant upside. So we haven't made too many mistakes in terms of our stock selection thus far. The experience we have given a very favorable experience to our investors. But we cannot. I mean, I would like to also urge at the same time that we cannot comment on future performance based on the past performance.
But then, what kind of a risk appetite or a risk profile investor needs to have this particular fund in their portfolio?
It's a like I said, it's a high risk, high return portfolio scheme, right? So one should have I mean, one should not invest. I mean, if it depends on the investor's risk appetite, so to speak, right? If one is looking for a high risk, high return kind of a category of investment, then certainly this fits the bill. And it's a long term. I would say it's a one should be positioned in this fund for the long term returns. One cannot come in and expect returns within a year's time because we invest into special situations. What tends to happen is special situations ensures that the stocks are out of favor for a considerable period of time, right? So stocks don't do well for long periods of time, and then suddenly over a say 2 to 3 year period, the returns start to come in because you are investing in stocks and they are going through their difficult phases. So by design, this fund is suited for long-term investors, just not for 1 year return seeking investors.
And how much should be the portfolio allocation to such a fund? 5 to 10%, or maybe more than that can be given?
Depends on the investor risk appetite, right? If you are I would say, I mean, I'm not an expert on this bit, but if you are a 25-30 year old who is investing, probably you can have a higher allocation to this fund, right? And in general, I would say investors should not dabble into too many mutual funds in their portfolio. They should have a concentrated set of funds in their portfolio, maybe 5 to 6 in number, because a fund itself is a diversified set of stocks. I mean, right? So uh, there should not be. I mean, if you are investing in too many mutual funds, what tends to happen is the overall return could be more like market return, right? Choose your 5 to 6 funds, and maybe depending on your risk appetite, have a proportionately higher or lower risk appetite to a fund like this. Invest allocation to a fund like this.
The expense ratio of this fund?
These are details which are available on the fund fact sheet.
All right, Roshan, thank you so much for being on the show today and explaining all aspect of India Opportunity Fund that you handle. And as Roshan also mentioned, high risk, high return, one needs to have a longer term horizon in order to be invested in this fund. Thank you so much, Roshan, being on the show today. On that note, let's take a quick break. After that, let's talk about your travel insurance. If at all you're someone who travels a lot, there are few things that you need to protect yourself from when traveling, especially abroad. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. And if you are someone who loves exploring and travel to different places, then this segment is for you. With the increase in travel, one of the important things that travelers need to know about is their travel insurance. This form of insurance helps cover a whole range of uncertainties and scenarios that can drain out a traveler's finances. Most countries require mandatory travel insurance while applying for a visa, but choosing the right travel insurance which covers all the risk of travel is important. So let's take the discussion forward with Manas Kapoor, Product Head Travel Insurance Policy Bazaar.com. Manas, good evening and welcome to the show. Today we're going to talk about all aspects involved in travel insurance. A lot of people know about it, but we are not sure about people implementing this when it comes to making their travel plans. So what kind of coverages, Manas, are we talking about when it comes to travel insurance, India and abroad?
Thank you for having me here. So if I tell you about the coverages, there are two types of coverage that are present, whether you are traveling within India or outside India. The first type of coverage is basically your medical expenses, which covers your medical related any emergency or any accidental happening that you incur while traveling to any destination, whether domestically or internationally. It can be any evacuation because of any hazardous situation, any any natural calamity. It can be any dental treatment or any accident that you face. So those are first set of coverages that is covered under travel insurance. The second is very pertinent, very important for the users to understand that they, like you mentioned, that there are very financial risks that are associated when you are traveling. There can be a loss of personal belongings. Your baggage can get delayed or lost while traveling. Your passport loss can be there. So these are certain types of unknown or less common benefits that people should know and should inquire while traveling internationally, specifically because the price that they have to offer once they undergo that particular constraint is something is very important for them to be safeguarding themselves for.
Also, what I want to understand is the kind of so you mentioned two types of travel insurance available. Now, according to that, there are obviously a lot of insurance companies giving you a lot of features involved in it. How should you select the right kind of policy for yourself, the kind of features that you should insure depending on the travel that you are set for?
So it depends on the destination that you are going. A, B, it also depends on the duration of trip that you are incurring. So, for example, if you are going to for leisure activity to, let's say, a couple of countries in Europe, a simple travel insurance which covers basic benefits will be sufficient. But let's say if a person who is senior citizen who is traveling to their family in USA, who
I think there's some kind of a problem in the connectivity, but then as Manas was informing us about the different type of travel insurance covers, let me just rewind that for all of you. So we are talking about emergency medical expenses which are covered under these travel plans. If there is a delay in check-in baggage, you have it covered over there. Any cost related to the cancellation of your trip, even that's covered. We have Manas online with us. Manas, if you can hear me, you can continue answering the question I asked.
so like I was mentioning, that senior citizen is one segment that they look for specific benefits like pre-existing disease, uh, their uh, their trip cancellation benefits, even for example, compassionate visit. That if they want any other relative to visit them to international boundaries, they extend their trip up to 1 year. So these are certain benefits that particular segment of users are looking for. Then comes a new segment that is gaining prominence right now after the pandemic is student segment, because now students have started to travel. There's specific benefits that are aligned to their requirements, like their loss of laptop, sponsor benefits. Then there is a benefit which is aligned to legal expenses, like if they get in a brawl or in a fight at a place. So those are certain unique benefits that people who are opting for student travel insurance can get.
Can you tell me the approximate costing for all the different kind of insurance plans that you just mentioned, travel insurance plans?
So ideally, we should consider that it is primarily geography dependent, because let's say US and Canada, which is as a geography place where the medical expenses are a little higher as compared to a country like Singapore or if I say Indonesia. So definitely the pricing of the product will be 2x or 2.5x in USA versus a person who is traveling to Singapore. I'll just give you an example. If a person who is going to Singapore for 10 days, the average cost would be somewhere around 1500 to 1000 rupees that he will be incurring for the travel insurance piece. But if the same duration is undertaken by a customer who is traveling to USA, that will be ranging around 3000 to 3500. So that is something, a price gap or price parity that is there between the geographies depending on the medical facilities and the cost of medical facilities that are available.
All right, one thing that people don't understand or often miss out is the kind of claim structure that you need to know before taking any type of plan, in fact. But then when talking about travel insurance, it gives you a peace of mind that okay, you have this travel insurance plan. But then when it's a situation where there's a crisis involved, how do you approach the insurance company and how do you claim the claim that you need to make?
That's a very good question, because that is something which we want the customers to understand, and that is because see, it's just not a document for visa or for carrying purpose. It's a benefit that the customer should have once they face any emergency when they are outside India or within India. Okay, so the basic structure around claims is that they just need to inform whatever be the intermediary, whether it is policy bazaar, whether it is the insurer, they just need to inform that particular intermediary that they have such claim that they have incurred, and they need to understand that what are the documents or particular things that are required for a particular claim. So, for example, in case of medical expenses, when they are either admitted to a hospital or just visiting a general physician, it is very important to take the bills that are present with them and have a soft copy and a hard copy with them so that they can deposit that to the insurer. Similarly, let's say if their baggage gets lost, there is a PIR report that is given to them by the airlines, by the carrier that they are traveling, which is very important for them to submit it to the insurer. So these kinds of documents is very important for the customers to understand that at the time of claim that they need to have, the process is simple. They just need to inform the intermediary or the insurer, and the rest will be taken care by them.
Manas, what is the maximum amount of coverage that you can get for all the purposes?
Uh, for example, medical expenses, there can be plans which are up to 1 million of coverage that customer can get. In terms of other popular benefits that customers inquire and look after on travel insurance. So, for example, trip cancellation, that has varied coverage across different plans. Similarly, passport loss, which starts from $100 and goes up to $1,000. Baggage loss, that also starts from somewhere around $100 and goes up to $2,000. So these are like and have varied.
I think we lost Manas over there, but then it's time to wrap up this segment also. Thank you so much, Manas, for being on the show and helping our viewers with how to make a travel plan with a proper travel insurance plan covered. We'll take a quick break, and after that, we'll be joined by Feroz Aziz, who will be explaining what exactly is REITs and InvITs, and also answer our viewers' portfolio-related queries. All right, welcome back. You're watching The Money Show. I'm Kavita Thapliyal, and today we are going to talk about REITs and InvITs. So what exactly has happened is with the amendments in the Finance Bill 2023, taxation of real estate investment trust and infrastructure investment trust has undergone a key change. The loan repayment distribution component from REITs and InvITs now need not be treated as income from other sources, but instead gets a capital gains tax treatment for a certain number of years. Let's welcome on board Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth, to talk more on this. Feroz, this can be slightly complicated for investors to understand, but then before we get on the change in the taxation part, let's talk about the kind of investment instruments REITs and InvITs are. So let's start with REITs.
Yes, Kavita, these are liquid real estate instruments.
Okay.
Basically, the biggest problem with real estate is illiquidity and size. REITs have tried to address that two big issues which real estate as an asset class undergoes, right? If you're going to buy a home, it's going to be a large amount of money and you're not going to be able to sell it over the counter. So REITs are nothing but mutual funds kind of instruments or pooled vehicles which invest in real estate. Unlike a mutual fund which invests in gold, real estate, debt and equity, REIT invests only in real estate. Basically, it's a listed instrument. There is a group of SPVs or REIT in real estate investment which are pulled together and they're listed. To name a few, there's Embassy REIT, there is a Brookfield REIT and a Mindtree REIT which are listed. And I think the first REIT was the Embassy REIT a few years back, listed at about 300 odd rupees, and it's at about 330, 340 rupees today. And it gives you a regular income. So REIT is defined as a vehicle which consolidates real estate investments, and there's somebody managing it for you, and those are liquid, and they're in small quantums. You can buy and sell them for as little as 300, 400, 500 rupees.
Feroz, why do you think a retail investor should be interested in something like a REITs or in REITs?
See, I think retail investors love to have some degree of regular income, especially in the latter part of their years. So REIT has this feature of giving you some degree of regular income because REITs more or less try and consolidate commercial property, which is beyond the reach of a retail investor. So the asset class which we are speaking about, most retail investors can never invest during their lifetimes because commercial real estate is even larger ticket sizes. That's one. Second is regular income generation coming from rental incomes of corporates. That brings in stability. That's number two. Since they are in the lowest tax bracket, there could be tax efficiencies for those dividend payouts. And these could, because it's reasonably tax efficient for a person who's not in the highest tax bracket. These could be the three reasons why a retail investor could be interested in these vehicles.
Got it. Let's talk about the change in tax. Earlier, what it was and how has it changed? Is it more investor friendly, or now it is not so investor friendly change that we're talking about?
See, it is it's a tax which impacts the return marginally. Yes, it is detrimental to the investor. That's why you would have seen on the budget day these REITs actually fell on the stock exchange by a reasonable quantum. Generally, they're not as volatile as they were on the day of the budget. Which was 1st February 2023. Now coming to what's the change, Kavita? The change is as follows. Whenever a property gets sold inside a REIT, there could be a loan outstanding for that property. The loan which actually is repaid, you have to reduce it from the cost of acquisition. Let's assume you had bought a property at 100 rupees and you had taken a certain loan. You sold it at 200 rupees. So the gain was 100 rupees, 100 mein kharida, 200 mein becha, the gain was 100. Now let's assume after you got your 200, you paid back a 50 rupee loan. So now you have to, your cost of acquisition of 100 comes down to the extent of the loan repayment. So now your cost of acquisition will become 50 rupees. So 50 becomes your cost of acquisition, not 100. So instead of paying tax on 200 minus 100, now you'll have to pay tax on 200 minus 150, which is a higher tax liability. So this was the change, and this would probably have the potential to impact the return by about 0.5 to 0.7% per annum for a REIT in the long run.
What about in REITs, the similar kind of change we are talking about?
In which the change is identical. They are more or less infrastructure projects. Like REITs are commercial real estate projects where private sector corporates could have borrowed or rented out those or leased out those properties for long periods of time. InvITs, as the abbreviation goes, it's investment trusts which are more infrastructure related.
Between the two of them, REITs and InvITs, which one do you think investors can be more comfortable in picking? You know, one, we are talking about infrastructure projects, which could be like a theme-based investment, if at all they want that kind of a flavor in their portfolio. But then talking about REITs, it's more about real estate, which also talks about diversifying in a particular asset class?
I think the first step for a retail investor would be a REIT, and then he or she can graduate to an InvIT. Later on, because the complexity involved in an infrastructure project is not for a common man to comprehend. Infrastructure projects have very different gestation periods, different kinds of lock-ins, different kinds of cash flows. A commercial real estate property is something which most of us are familiar with. So I would say starting with a REIT, and then maybe if you really want to graduate out to something more complex, then it will be InvITs.
Any particular change in the strategy owing to the change in the taxation that an investor needs to do, or there's nothing that one can really do?
No, of course, there's not much you can do because this taxation is at the fund level. This is not something which at the hands of the investor does it make any difference, but the returns would drop. I personally think that in a high interest rate environment like where we are today, where the corporate government bonds can give you 7.2% pre-tax for a retail investor, and that almost becomes post-tax for a person who's just retired or something. When 7.2 government can give you, the need of a REIT or an InvIT doesn't exist to my mind unless 10-11% is achieved through these complexities. If interest rates on the government side were at 4%, and if REIT was giving me 8, then it was remunerative enough for an individual investor to actually go through this complexity and go through the volatility on a daily basis of a listed vehicle, which of course is significantly lower volatile than an equity instrument, but it's still volatile. If I have to numerically put it, it is 60% volatility of Nifty is what an embassy REIT has thrown up for the period it has been listed.
Feroz, so far, how is the investor response in these two investment instruments? Has it been upbeat or very slow response?
No, it's been reasonably upbeat. See, unlike a mutual fund, Kavita, these have limited units. See, in a mutual fund, if I want to tomorrow invest 200 crores in a Kotak Emerging Equities Fund, because I want to invest 200 crores, the NAV will not move just because of my demand. But in a REIT, the number of units are fixed. The number of listed shares are fixed. So a larger demand could create a larger price rise and in turn give a capital appreciation to a REIT owner, which is not the case in mutual fund. Mutual fund, you're dependent on the fund manager's capability. Demand and supply for that mutual fund will not impact the price. So to answer your pointed question, have they generated enough interest? The answer is yes. Have they generated supernormal interest? I would say no. Given the love for real estate in India, I would expect a larger demand, but I think it's been subdued. But having said which, it's been not as bad as it could have been.
All right, that was all about REITs and InvITs that we had for our viewers. But then, Feroz, let's move on to our Q&A because there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? Let's get you all the details on this. But you can send your portfolio queries on our WhatsApp number. In case you're watching us live, you can WhatsApp us on 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. So we have Selva Guhan, our first viewer, on phone line with us. Hi, good evening. How are you doing?
Hi, I'm good. Thanks.
Thank you so much for sending us your query. And as I can see, you want to understand what kind of a scheme to select, a regular or a direct scheme, right?
Yes, for a fresher who wants to start the SIP.
All right.
For long term, which one will be best for new joiners?
So you want to know what kind of fund you should be investing in and whether you should be going through a direct scheme or a regular one?
Yeah, like the fund as well, the regular or direct, because when we go with direct, we need to register with multiple AMCs.
Right.
So that's the thing, like can we do with regular? What might be the difference for long term? It affects our portfolio.
Sure. In order to recommend a fund to you, I just want to understand your investment time horizon, what's the kind of amount and the corpus are you looking at?
Let's say 1 crore. As a corpus, I plan to invest 5,000 SIP.
Okay. For how many years?
It's like 15
years.
15 years.
All right. Feroz, these are the details for you. But before we answer the fund recommendation part, let's talk about, he sounds like a fresh investor, first-time investor. A regular scheme for him?
No, I would say, Kavita, no, not a regular scheme. If he's looking at your show and taking advice from you, there's no point actually going regular. You're just going to give more money to the asset management companies. Logistically, it's not as difficult. There are quite a few consolidation platforms. You can buy it through BSE Star or MF Utility. You don't have to individually register with each AMC. You can cut one check and make a payment to several AMCs. So I don't think the logistical difference of not having an intermediary is so compelling for you to go regular. So point one. Point two, I think, of course, there are plethora of investment opportunities like Kavita always mentions. But I think, Kavita, I have to be honest with you that you've had the passion to pursue personal finance for over a decade as a professional. And I think, Selva, if you're looking at the schemes and deciding them all without the help of another person other than the show, you should never buy regular. Over a period of 10 years, the direct NAV is going to be far more remunerative for you than the regular because the price difference between both these, the portfolios are identical, right? There's no difference in the portfolio, but there's a difference in the cost. If the cost is down by 0.75 to 1%, over a period of 10 years, you're going to almost get 20% or 25% of your total invested amount as an extra return by going into direct as against regular, right? Assuming the scheme choice is not being assisted by an intermediate. So the schemes which you can pick for yourself, I can give you 8 of those, which are tested from a more futuristic standpoint and not just a past performance standpoint. So they may not look very attractive if you look in the rear view mirror. Like a quant active fund for the last 1 year would show you -4%, but it's still in the recommendation list. In fact, reasonably confident that it'll do well from a future standpoint. So HDFC Small Cap, SBI Contra, Quant Active, ICICI Dividend Yield, Kotak Emerging, HDFC Flexi Cap, SBI Large and Mid Cap, and ICICI Focused Equity. These are the funds you can choose to begin with. If you have an amount of 5,000, don't hesitate to have eight AMCs and 8 schemes in your portfolio and keep adding to it as your amounts go up and your incomes too.
Feroz, now since Selva is a fresh investor, first-time investor, a regular scheme would have just gotten him introduced to mutual funds and maybe to the financial instrument that he's looking at. Once he's into a direct scheme, what all from his part he needs to keep tracking in terms of doing the homework? It's not only the the registration issue that he was talking about. He also wants to understand, because once you take a direct scheme, you have to monitor your portfolio, track your funds, make the changes accordingly. What should be his checklist in order to go ahead in this investment journey?
Yes, Kavita, see, the first step of deciding a mutual fund is to decide the mutual fund scheme. If you've already decided, then you can use any technology platform. There are quite a few of the technology platforms which provide direct schemes as an alternative, and they provide you the execution platform at a flat fee, at a marginal flat fee. That's a better choice for you, is what I personally think. If these are the 8 schemes which I rattled out, if that's the one he wants to go ahead with, then he can choose any platform. Google out platforms, fintech platforms, which help him buy units and SIP standing instructions creation for these 8 schemes. And he should choose direct because he already has chosen those schemes. And he does not have to pay the intermediary, which in this case is the fintech platform, which can help him set it up. So he does not have to monitor any more than a regular scheme, because the regular scheme's performance and the direct scheme performance is going to be identical only to the extent of the cost. The direct scheme is going to be greater. So the extent of monitoring a regular scheme will need is exactly the monitoring the direct scheme will need, unless he has chosen an intermediary in the form of a distributor or an advisor whose assistance he chooses to have to manage the schemes.
Let's move on. We have Mr. Sridhar from Coimbatore with us on the phone line. Good evening, sir. How are you doing?
Hello, ma'am. I'm good. Thank you. Thanks for asking. I'm doing great.
Thank you so much for sending us your query.
Yeah.
Okay. I like the fact that you understand the power of equity investments, and you are already investing in mutual funds, 50,000.
About 50,000 in equity mutual funds. To be precise, I'm investing in Canara Robeco Blue Chip Equity, Kotak Emerging Equities Fund, SBI Contra Fund, SBI Small Cap, and Quant Active Fund.
Okay, we don't have the details of these funds, I guess.
Okay. Yes,
Yeah.
I did not,
So,
because my question was very generic, in fact, because my focus shifted to equity ever since the COVID period.
Sure.
Otherwise, I have not very familiar with the equity investments because I'm the first person in my family to get into equity kind of investments. So my question was how can we completely be dependent on equity investments for all of our financial needs that are coming up in the future in the 20-30 years?
Sure.
That was my question.
Lovely question. I think even other viewers would have a lot of takeaways from this particular question that you've raised, and this is something that comes on everyone's mind, or every investor who wants to, who's planning to set off on a journey related to the equity investments. Feroz, very important question, and I'm glad that Mr. Sridhar actually raised this question because, although most of the time it looks like a very basic thing to ask, but that's the most important thing. How can you trust equity for all of your financial goals? I mean, there has to be a process, a strategy, but then why most of the time equity?
Kavita, see, if you look at equity, Mr. Sridhar should, I'm sure, with the kind of experience he has had and he's investing 50,000, would have realized that equity has one name, but it's very diverse asset class. A stock of a company which is into IT sector, because he is in IT sector, is going to behave very differently than a stock of a company which is in the FMCG sector. Hindustan Unilever's behavior as a stock is going to be very different than an Infosys, for example. So equity, all of them are called equity. But the diversification of the asset class, because it is businesses could be multiple, could be in different geographies, could be in different sectors. So since equity is the foundation of a financial system, and any business for that matter can be called equity. Now, if Anand Rathi Wealth Limited is listed, which it is a different kind of a business. And the kind of diversification you get in equity, it's not one stock. It's not one kind of stock. It's not one sector of businesses. So that's why equity has the potential to help you fulfill most of the goals. The second part of the question, can you rely on past performance? The answer is no. Of course, you can't rely completely on past performance because future is going to be different each time. But can you completely disregard past? The answer is no. Can you fundamentally disregard the principles of finance? The answer is no. A business equity has to do better than debt. Right? If you borrow money from a company, if a company borrows money from a bank and then makes plant, machinery and does a business, the return on equity has to be greater than the return on debt. That's when a smart owner of a business is going to borrow and invest. Right? So point is, fundamentally, books will also tell you that return on equity has to be greater than return on debt. And if risk-taking will not remunerate the owner of the business, then risk-taking will collapse. And if risk-taking collapses, the world collapses. So I think in the long run, equities have to outperform debt. And that's why it supports most of our goals as individuals. If you entrust a fund manager, who in turn entrusted to professionals who run those businesses of the stocks which he buys.
All right, Sridhar, I hope that answers your query. Also for your funds, I would request you to send us your question again with your funds details. We have our last viewer on phone line, our Arunachalam from Coimbatore. Hi, good evening, sir. How are you doing? Hello, I think this is Mr. Tuhin Sarkar from Kolkata. Good evening, sir. How are you doing?
Good evening, all fine. How are you?
Thank you so much for sending us your query. We have your funds detail: Quant Infra, Quant Active, Kotak Equity Hybrid, Kotak Small Cap, ICICI Pru Multi-Asset.
Exactly.
You want to be invested for how long?
I'm invested for last 3 years.
And for how long?
Another 3 years.
Another 3 years. All right, Feroz, more 3 years to this portfolio. How are the funds?
Kavita, I think Mr. Tuhin should change two things. One is the Quant Infrastructure Fund, which has done very well for him, but it's a sector fund. So it's on a principal basis, it should be an exit. Kotak Equity Hybrid Fund. Hybrid funds, at least in the new tax regime, will be beneficial. But I would say that mixing both debt and equity doesn't make sense. That's point two. ICICI Multi-Cap Fund could be exited. The schemes which he can enter in his portfolio as DSP Equity Opportunities, which is a large and mid-cap scheme. Franklin India Blue Chip, which is a large-cap scheme. HDFC Flexi-Cap, ICICI Pru Dividend Yield, ICICI Focused Equity, Kotak Emerging and SBI Contra. These are the 7 schemes which he can note down. 3 of them which he is exiting. And 7 of them I have read out. which will give a very diversified portfolio, because all the schemes which I read out are from different categories and largely from different AMCs and fund managers too.
All right, I think that will be all. Mr. Mlachulam, is there anything else you want to ask Feroz?
Yeah, I want to ask one more question. Nowadays, bank interest rates has increased. Now, a normal citizen gets around 8% from various banks. So, whether this SIPs are beneficial nowadays, seeing the interest rate increase in the banks?
Sure. Feroz, I'm running short on time, but then just 30 seconds.
Yes, Twin Sahab, I think SIPs of equities don't compete with bank fixed deposits. So don't stop your equity SIPs, because the objective there is to make 13, 14, 15% per annum. So 0.5%, 1% move in interest rate should not change the direction of your equity investments. Having said which, on the debt side, whether given the tax rate changes and also the increase in the FD rates of 8%, even post-tax, I think quite a few FDs make more sense than pure debt funds in the current situation. But don't change your direction of equity investment at all with this increase in interest rate.
All right, with that, thank you so much, Feroz, being on the show and helping our viewers with their financial portfolio. And time for me to sign off, but then I'm going to leave you with our WhatsApp number and email ID where you can send us your portfolio-related queries. Thank you so much for watching. Goodbye.